Ridham Desai, Managing Director at Morgan Stanley, is now joining us. Ridham, good morning. Thank you so much for taking out time for us. Firstly, with what's happened in the last 26 days at the start of 2016, are you surprised by the velocity of the fall and suddenly how everybody is getting scared to own equities?
Good morning, Pankaj. Good morning to your viewers. Yeah, I don't think anybody anticipated such a dramatic start to the new year. So it's certainly been a dramatic start. It's not been very often that the markets around the world have lost double digit at the start of a calendar year. In fact, it's one of the worst starts to a calendar year in a long time. So I don't think we can claim that we were expecting this. We were, of course, expecting the 2016 to be a challenging year. At the start of the year, our expectation was that global equity markets will deliver single-digit returns. So I think that expectation has probably now become a front-ended loss for the markets. The rest of the year, I think, remains a bit challenged. Maybe the returns are slightly better now because share prices are lower, but globally, the world is facing a high amount of leverage, slowing growth, particularly problems from China, which is deleveraging and is slowing down, which will, I think, create challenges for growth overall.
Right. It feels as if it's like 2008 when in Jan we started to see a fall. Suddenly people became scared. Do you see such sort of a scenario coming in, such sort of EPS cuts coming in, which could lead to such a sharp fall of 30-40%?
Presently, that's not our base case scenario. We're not in a 2008 type of situation. That was a unique event, I think a rare event. I'm not surprised that people keep comparing every market fall to 2008. We did that in 11, we're doing it now, because the memories of 2008 are very fresh. But 2008 was quite unique and it doesn't keep coming all the time. I think this is more a traditional correction in the markets. A lot of global equity markets actually are in bear phases already. Marked by steep declines from their mid-year highs last year. In fact, I was seeing a chart which showed that there are only two equity markets globally that have fallen less than 10% from their peaks. Most markets are down more than 20%. And somehow that seems to be the definition of a bear market. So you could say that there's a bear market almost everywhere. But it's not like 2008. 2008 was a crisis triggered by a series of events that I don't think will happen so quickly. Can that happen in a bear case scenario, in a really worst case scenario? Yes, of course. You can attach some small probabilities to such things happening again and again, and we should always be careful of those things. But for now, I don't think that's our base case scenario.
Right. In the last 3-4 years, if as you would be doing, in tracking of emerging market flows or percentage of emerging market flows that we are getting, it's continuously reducing. Do you see a risk much more there if Fed continues to hike and dollar index continues to go up?
So India's share of EM flows has, or rather I should say, the share of EM flows in FPI flows in India have reduced over the past 10 years. India's flows are far more diversified than the typical EM. Indeed, 2015, I think India got separated from the EM basket quite distinctly. If you look at the correlations of returns, EM versus India, go back to 2007 or 2008, correlations are riding at 90%, which means 90% of the performance from Indian equities was explained by what the EM asset class was doing. Only 10% was idiosyncratic to India. That correlation peaked and then started falling, is now in the 50s, which means less than half of India's performance, or about half of India's performance, is explained by global factors. The remaining half is explained by India-related factors. This correlation is the lowest that we have seen since 2003. So India has got, if I may use the D word, decoupled from the EM asset class. And that's also visible in the flows. I mean, if you look at EM outflows since the beginning of last year, they're aggregating in excess of $85 billion. India has only experienced a fraction of those outflows. If in anything, actually, even if you measure from January 2015, India is still witnessing net inflows from FPIs. So India has got differentiated. In any case, it is being less treated as the classical EM. The classical EM is a commodity-driven place. Commodity prices having fallen has rocked the cyclical case for these EMs. On top of that, they are facing structural issues, either because their economies are experiencing aging or high debt levels. These are not issues that are troubling India. In fact, if we evaluate India on our 3D model, which is debt, demographics, and deflation, India is clearly standing out in the world. So on a relative basis, India looks actually fundamentally much better. And that's also expressed in the way investors globally own India. So India is still a very well-owned market, valued at a premium to emerging markets. The premium is close to record highs. These are risk factors if the EM asset class rallies, but I can see these sustaining for a while because of the differentiation that India offers on a fundamental basis.
Right. After the recent correction, after actually what happened on the government side 2 years back, expectations were very high. Now with the recent correction, with people pulling out a lot of money, you think expectations are now becoming reasonable, and that's why chances of outperformance are higher because expectations are quite realistic versus what they were 2 years back?
No, so let's get the facts out first. Since May 2014, India has outperformed in dollar terms MSCI Emerging Market Index by a whopping 35 percentage points. I think this is the biggest successive outperformance track record that India has had in its history. So there should be no doubt left about India's fundamental performance in this period. On an absolute basis, it doesn't look good, but nothing can be looked at an absolute basis. We live in a world, we're a fairly large economy, we're amongst the top 10 markets in the world, and therefore the relative context is very important. So look at what India has achieved since 2014. Our real rates have turned positive, our current account deficit has fallen, the fiscal deficit is at multi-year lows, FDI is at multi-year highs, government capex is going up 20%, industrial growth is at multi-year highs, inflation is significantly lower. So the macro rebalancing that we have achieved and the shift in the productive dynamic that we have achieved is quite unmatched compared to any other place on the planet, which is why India has delivered such stellar outperformance. The consequence of that is that India now trades at a very rich multiple relative to EM. That doesn't mean the multiple is about to crack, but you have to bear that in mind that if something goes right in the EM world and if EM starts to rally, not our base case as such, but if it rallies hard, India will actually underperform. Even though on an absolute basis the Nifty will be a lot higher, and people back home may feel that, oh, okay, we're back in a bull market. But actually India is already in a big bull market if you look at it on a relative basis.
Right. So even if there is a risk-on trade, our overall performance in terms of percentage may be lower.
On a relative basis, the absolute levels will obviously rise, and that will make people feel better. In fact, that's also the context of growth, which is that people look at India's growth performance and feel that not much has happened. But you have to see it in a relative context as well. In the 2003-2008 era, when we did 8.7% average GDP growth, the world was growing at about 5%. Today, the world is circa 3 or sub 3. And in that context, our 6% growth actually is a reasonable amount of growth that we can deliver. We need global growth to recover for that growth number to rise meaningfully from here. That doesn't mean we don't have our own upside. Of course, we do have it. And I think the government and the central bank both have done a fairly stellar job in rebalancing the economy, and therefore growth, in our view, should actually pick up in the next 4 quarters. But you can't anchor your expectations to what happened in 03-08 because global growth is not going back to 5% in a hurry.
Right. How would you look at different asset classes? So, let's first talk about crude and say if it falls further from here on. Would it actually benefit India? Or, because of the global liquidity concerns, it may actually turn out to be negative. How should one look at crude prices?
So there are 2 aspects about falling oil prices. One is that oil prices have traditionally been symptomatic of global growth. And if they fall, then it probably indicates that global growth is not so good. That view can be challenged a bit because we have a different supply dynamic in the marketplace today versus at any point in time in the last 30-40 years. We have a shift away from fossil fuels, which is causing disruption in demand as well. But the India factor, which I think I'm more competent to comment on, is that when oil went from $120 to $50, we got a benefit of $70 billion. India imports on a net basis 1 billion barrels a year. That was a massive benefit for India relative to its GDP. When oil goes from, say, 40 to 20, the benefit reduces on an absolute basis to just $20 billion. On the other side, we could actually suffer because we receive about $35 billion of remittances from the Middle East. India has a large amount of people who work in the Middle East. The Middle East jobs are clearly linked to oil. If you look at, say, Saudi Arabia, it's running a very large fiscal deficit now, over 20%. It's not sustainable. Embedded in that fiscal deficit is an assumption that at some point in time, oil prices will recover. So if they don't, then it's possible that the Middle East may have to cut spending. If they cut spending, it will mean job losses for Indians. It will mean reduction in remittances. So the net flow effect in India will actually turn negative then. So I would reckon that India will not want oil prices to fall dramatically from here. Now, one point that I'll make here, Pankaj, is that the way our policymakers have handled the oil price fall, I think, is very noteworthy. So the way the government has done this is that it has actually not passed on the oil price fall to the consumers. And there's a lot of debate out there that maybe the government should have done that and the consumers would have benefited and the economy would have been stronger. I'd argue actually that it may not have been the case. Because when oil prices started falling, India's real rates were negative. What consumers may have done at that time was take the oil fall largesse and spend it away. Our current account adjustment may not have happened. And what the government instead did was save that money by lifting taxes. Now we have that money saved up in the government coffers, which the government can now utilize and spend. And that's exactly what I think will happen in the next 12 to 18 months. So having adjusted the macro, having shifted consumer behavior, having prompted them to save a bit more rather than being spendthrift, the government can now utilize those resources to spend and lift the economy. So I think this was brilliant policy making. Obviously, it looks extremely smart in hindsight, but when it was being done, I think the government was very well advised.
Right. So the 6-7 rupees that they are charging as far as taxes are concerned, if that would have gone to the consumer, it would have probably not been used for investment.
Exactly. It may have been spent away and then the benefit would have been temporary. Instead, right now, we have a great cushion against rising oil prices. I don't know where oil prices go, but what I can see is that if oil prices do rise from here and if they rise sharply, India is better cushioned than at any point in time in the last 20 years because we have so much collected in taxes. So the government may not necessarily want to burden the consumer, then it can cut taxes. So that flexibility is what we have gathered over the past 18 months. And I think India is actually getting rewarded for that flexibility, which is what you see in terms of outperformance and relative multiples.
Right. Most of the data, Ridham, that we've got in the last 12-18 months in terms of macro data is pointing out towards a cyclical shift on the higher side, or at least we can say that the economy is recovering. But that's somehow not reflected in the Nifty 50 company in terms of performance of the EPS that they are giving, or probably the overall earnings. How much time generally it takes to adjust? Will it come in with a lag effect of 6-8 months?
No, actually, I think there's a different problem here with respect to the earnings. So, firstly, on the economy, I think there are two areas of strength. One is consumption and the other is government capex. Of course, I'll add a third area, which is foreign investments. There are two areas of weakness, which is private capex and exports. So the economy is not firing on all cylinders. It's a mixed bag. Unfortunately, I think private capex may remain sluggish for a while because the private sector has got excess capacity and global growth doesn't look very good, so exports may remain weak as well. So India has probably to ride its growth on government capex, which is doing quite well, and consumption, which we think is picking up quite nicely. Urban is certainly showing the signs, and I think rural will also do well in the next 12 to 18 months. Now, as far as earnings are concerned, the earnings is a nominal number. So, people look at the GDP growth and they look at the real number. For a moment, you should also look at the nominal number because that's what drives earnings. So look at the previous decade. India's real GDP growth average, say around 7%. I'm using the old series for comparison purposes here. Nominal growth averaged around 13%. Today our real growth is circa 6%. Nominal growth is also around 6%. So actually, even though real growth is not very different from the trailing 10 or 12-year average, the nominal growth is actually less than half of what it used to be. And that's what's hurting earnings. So if you ask me one indicator, it's actually the WPI index, or what we would call as producer price deflation.
Which is in the deflation territory.
Exactly. If that turns, then I think earnings will also turn. And given that the rupee is losing a little bit of ground, and I think the rupee could lose more ground because it is a bit overvalued, it will actually augur well for earnings. If commodity prices start falling, it'll augur well for earnings. So for us to see it in the Nifty, I think we need the PPI deflation. I'm making it very simple. There are lots of other variables, but very simplistically we need to see PPI deflation end.
Right. So deflation and the worries over there, once that comes out, or probably the global growth returns to a positive number, that's when you would be more positive.
No, global growth is already positive, but that's the commodity prices are reflecting both structural and cyclical challenges. And if they stabilize, then that will be good.
Right.
Also, the rupee has been a stellar outperformer. So if the rupee gives up a tad, then that will also be good.
Right. As far as just the earnings recovery is concerned, when you expect 4 quarters down the line, 5 quarters down the line, when do you expect good percentage growth to come in?
We are expecting earnings to turn in the course of the next 12 months. Of course, I must caveat this by saying we were expecting the same at the start of last year, but it didn't quite work out. The fiscal tightness was a lot more than we anticipated. Global trade actually collapsed, which was not in our numbers, and PPI deflation was much more severe than our initial forecast. So those were the things that hurt our earnings call. We have a sanguine earnings call for the next 4 quarters with these assumptions in there that we don't see further PPI deflation, and there will be a bit of relaxation on the fiscal side, which is the government will not tighten at the same pace as it has over the past 18 or 24 months.
Right. As you just mentioned that there could be a possibility that rupee may weaken further. How would you essentially play that? Would you be overweight on exporting sectors like IT and pharma?
So there are 3 portfolio trades that we have on. One, as I mentioned, is on consumption. So we like both urban and rural consumption. I think both will recover quite smartly over the next 12 to 18 months. Jobs are back. I think the government will spend a bit of money in rural India. It looks unlikely that we'll have a third drought. I think the weather, even though overall the weather conditions in the world are very volatile, it seems like we may have better rains this year. So this should help consumption. The second trade is on the policy side, which is we expect government capex to remain strong. So select industrials will do well. And we also expect the central bank to cut rates. So we think retail, private sector banks will do well. And the third trade that we have is that the dollar continues to gain strength as it did in 2015. On the back of that, we are buying technology or software services. On healthcare, I think there is still a bit of a valuation adjustment left to go. So I prefer tech over healthcare.
Right. As far as the valuation adjustment is concerned, both pharma as well as FMCG, which had a great last 5-6 years, are seeing the margin versus valuation adjustment.
Yeah, I think that adjustment is happening, and it's going to probably happen slowly over the course of 2016 as well.
Right. The point that you made about urban consumption, which sector should one play that via? So via the banking space, via the auto space, how would you essentially see a recovery over there or see some signs of further pickup in urban consumption?
Now, I think a slew of consumer discretionary sectors like autos, retail, media, QSR, all these I think look interesting from an urban consumption standpoint.
Right.
Retail banks as well, though retail banks is a broader story. It's not just a consumption-related story.
Right. So you mentioned about retail banking. Now, first it was private versus PSU. Now, within private, we have 2 bifurcations, retail versus corporate. You think corporate banking names would essentially be slightly vulnerable, or 2016 may see some asset quality issues which we need to solve, which all countries do?
So firstly, I think loan growth may have seen its worst. So I think aggregate loan growth should improve a little bit through the course of 2016. And it will probably be led by the corporate sector because retail loan growth is already at multi-year highs. So I think some recovery in corporate loan growth should happen during 2016. Not a whole lot, but I think some. I'm not distinguishing so strongly between corporate and retail, but your point is valid, which is that there is still a little bit of pain to be taken care of on the NPL front. It's more relevant to SOE banks than to private sector banks, but I think if the private sector banks who are suffering take this pain upfront, then I think the stocks will actually do quite well. If that pain is delayed further, then the stocks will tend to languish, waiting for that pain to be absorbed.
Right. The second part or the second story of 2015 has been the strength of the mid-cap, small-cap index, probably because of what's happening on the DII side, the flow of liquidity. And it's always a function of return flows, returns. You expect the DII side to see slower flows, which means that mid-cap index may have capped the gains in the near term?
Pankaj, for the past 18 months, we've been talking about the domestic super liquidity cycle, which is we think there has been a structural shift in the flows into equity mutual funds from domestic households. And we think this will sustain over the next several years. So in my view, the $1 billion number that we're seeing on a monthly basis is a good number, and it will probably continue There may be some aberrations along the way, but it's a number that's fairly sustainable. If anything, actually, that number will grow in size over the next 3 to 5 years. So I think domestic flows will be strong. Now, as far as mid-caps are concerned, liquidity could be good, but stocks have to be purchased because those companies are doing well or the valuations are reasonable. And if the valuations go out of control, as it happened in certain mid-caps in December, you can see that they suffer a lot of pain when there's a bit of pain in the market. So I think investors should be very cognizant of the price at which they're buying shares and stick to businesses that are good quality businesses, and that should work out pretty well.
Right. Ridham, just a last word. 2016, after the correction, should it end on a positive note?
Yeah, hopefully. It's a challenged, low return world. We've had some upfront pain in January, so I think that makes the outlook for the rest of the year a little better. There are several risks on the horizon, so we should not lose track of that. My own view is that you don't buy equity shares for a 12-month view. Investors should be looking at the next 5, 7, 10 years, and I think the outlook for the next 5 years remains very strong. And all these corrections represent opportunities for investors to engage into equity markets. The best way to do this is to do it on a systematic monthly basis and not try and time it. And that works pretty well in the long run.
Right. Ridham, thank you so much for taking out time for us. Always a pleasure talking to you. That was Ridham Desai of Morgan Stanley.